sometimes the first week of the year, you get some things in there that will tell you a lot about what's going to happen. But I think what we're seeing more is a little spillover from last year. I don't see really anything different. Despite the geopolitical drama, people largely staying invested. So let's look. Some interesting things. XLI at the top is that's industrials, and EEM, that's emerging markets by traders like it. There's a broad market. There's some semis, the Qs, nothing too out of the ordinary. But seeing two sectors here makes me want to look at the sectors. Let's look at sector ETFs. Sometimes trends start in the sectors and then make their way out. But honestly, there's not a ton new here. Look, you got financials and industrials at top, technology. So risk is still on here. Look at where the outflows are coming out of in January. Utilities and staples. That tells you a lot about people not being concerned about what they're seeing on the news right now. Let's also look at our risk on and risk off proprietary indexes of flows. And you can see it's as obvious as day. People are going into the risk on stuff, which is like discretionary, semis, EM, growth, small caps, and they're coming out of stuff like staples, utilities, short-term debt, and value. So, Scarlet, nothing really is phasing investors. A lot of the inertia from last year is just coming right into this year.
All right, continuation from 2019 then. So let's bring in Mike Venuto. He is CIO of Toroso Investments, and Vildana Hajric, a cross-asset reporter for Bloomberg News. Mike, let me start with you because we got the everything rally in 2019 where everything worked. You had the 60-40 traditional allocation. That worked, although risk on worked even better. With all the tensions in the Middle East right now, how are you positioned for this year?
So we started to position more conservatively late in 2019. So we brought in things like longer-term treasuries. We're not the ones scared of rates going up. We're more concerned with their behavior inversely correlated to things like BTAL, things like gold. We've been always a conservative investor, and it's nice to accept the gift we got last year, and let's protect some of those gains.
All right, we'll get to BTAL in a moment, but Vildana, you've been talking to market participants here, and one comment that really got my attention was how Iran has replaced trade war as the biggest risk to markets. What are you hearing from folks?
Iran has certainly replaced some of the trade headlines that we've been getting over the last couple of weeks. We did see knee-jerk reactions in the market, in stocks, in oil, but we did have President Trump come out and say that Iran seems to be standing down. Investors I speak with, they tell me that they're much more focused on fundamentals. They're looking forward to the earnings season that's supposed to kick in next week. So there is this sort of sense that maybe cooler heads will prevail. Inflows into XLI, XLE, but we'll see if we can maintain those now that things seem to be de-escalating.
And Mike, one of the ETFs in your picks here I want to hone in on is BTAL.
Sure.
This is an ETF I hear over and over from the aficionados. A lot of ETF nerds love this thing. It reminds me of a Terrence Malick movie. All the critics love it, but no regular people have ever heard of it.
Explain what it is first.
BTAL goes long, low beta stocks and short, high beta stocks. It's a market, it's a hedge fund basically in an ETF. Explain to a regular person why this might make sense in a portfolio.
Okay, so the short version is you're getting $1 worth of insurance for 50 cents. That's been the historical return. So most things that you want insurance, you're paying more than what you could get out of it, right? So this is an asymmetric risk return profile. Nobody knows if we're going to have a good market, bad market this year, but we know the tinder is ripe. If we get a spark like the Iran situation she was describing, having something like this in there that for 50 cents can protect $1 is beautiful.
Yeah, you'll take that. Let's turn to ETF issuers now, Vildana, which Mike, of course, is one. Who are the winners and losers of 2019? And I guess to that extent, will the big brands win again in 2020?
That's a really good question. If we look back to 2019, we had BlackRock come out on top again for the 6th straight year. They took in $116 billion in terms of their cash haul, followed by Vanguard, $104 billion. And together, those two, they made up 2/3 of the entire haul, followed by State Street, Charles Schwab. They're taking in about $23, $24 billion each. But it does set the stage in terms of 2020 for some of these bigger players to continue dominating the market. And it does also show how difficult it has been for smaller issuers in this very competitive environment.
I was just going to say, you don't see Mike in there in that league table because he's an indie issuer. Not yet, he says. But he works with some pretty high-profile issuers.
Yeah, he's in the top 70, I think. Yeah, and what's interesting about you, a white label issuer, normally they're taking very, very tiny issuer, people who have ideas. You have taken on bigger clients like SoFi. Talk a little bit about what's going on there, why the bigger clients seem to be going to your firm.
So the original white labelers all came out with what we kind of call that halo, right? They said if I put the halo of an ETF on a strategy and I do the field of dreams, if I build it, they will come. That era is kind of past, right? Now what we're into is thinking more of the trust of the ETF structure, more of what we think of as the ETF as a service, right? You take something that's a good strategy now or is efficient today, and you make it better by putting it in the ETF wrapper. So for SoFi, they were able to engage the cohorts better. For Blue Cross Blue Shields and Aware, we were able to make it more accessible. For our friends with the Risk Parity Fund, we were able to take something and make it more tax efficient. So we had a great rookie year. We did 8 funds and $500 million in assets. So we're glad to be in this space now.
You have to see the benefits of the ETF structure for what it is rather
Yes.
than just tacking it on to your existing offerings. Vildana, speaking of white label issuers, what happened with ETF MG, the issuer of Hack, losing a lawsuit to NASDAQ? I feel like it didn't get as much attention as it should have.
Because it happened during the holiday week. So a couple weeks ago, we had NASDAQ win its $78 million breach of contract suit against ETF MG. We had ETF MG come out and say that it's denying the suit, it will appeal the suit. NASDAQ, of course, had said that ETF MG was misappropriating some of the profits from Hack, which is its cybersecurity ETF. But NASDAQ told Bloomberg that this was a really big victory for the ETF industry.
And Mike, you are a white label issuer. Has this stained that world of white label issuers? Are you concerned?
I mean, for us, it's an opportunity because we're out there selling trust. To me, this isn't really about white labeling. This is about, if you read the ruling from Engelmayer, Judge Engelmayer, it's about breaking trust and breaking contracts, right? Like, I don't know what actually happened, but that ruling says this could have happened in any industry.